In every era, there is a resource that silently governs the pace of empires. Gold shaped the 1500s. Coal shaped the 1800s. But today, the world is locked to something far more volatile: oil. And here's what nobody tells you. The modern energy system is not controlled by the nations that consume the most oil, nor by the corporations that extract it. Instead, the rhythm of the global economy depends on a bloc that manages just 40% of world production, yet exerts influence far beyond that share. A cartel with no armies, no formal borders, and no democratic oversight. One decision inside a private conference room, sometimes a single vote, can ripple across continents, raise or collapse national budgets, and shift the price you pay at the pump by morning. Here's why this matters: your cost of living, your country's inflation rate. Even the stability of entire governments can be traced back to the way OPEC learned to weaponize scarcity, abundance, and perception. The connection between your daily expenses and a decision made thousands of miles away traces back to the 1960s, when a group of producers realized they were selling the most desired industrial resource in history, yet earning almost nothing from it. Before 1960, oil companies based in the US and Europe dictated prices unilaterally. Producers in the Middle East, Africa, and Latin America held the reserves, but not the power. The imbalance mirrored centuries of colonial extraction. Resource-rich nations remained politically independent, yet economically dependent. This is where the pattern begins. 5 nations: Saudi Arabia, Kuwait, Iraq, Iran, and Venezuela understood the leverage buried beneath their soil could rewrite the global order. They formed the Organization of the Petroleum Exporting Countries, not as an energy union, but as a strategic counterweight to Western oil majors. A quiet revolution hidden inside a bureaucratic acronym. At first, nothing changed. OPEC lacked coordination, data, and the political cohesion needed to influence international markets. Western companies continued setting posted prices, often lowering them without consulting the governments whose budgets depended on that revenue. But history has a habit of converging crises into opportunity. Throughout the late 1960s, domestic pressures grew inside producing countries. Populations demanded sovereign control over national resources, a sentiment strengthening from Algeria to Iraq. Meanwhile, rising global demand made oil not just a commodity but a lifeline of industrial civilization. And then, in 1973, the world collided with the cartel's first demonstration of power. The Arab oil embargo is often remembered as a geopolitical retaliation, but beneath the headlines lay a deeper structural message. Resource leverage works only when scarcity becomes visible. When Arab members of OPEC restricted exports to nations supporting Israel during the Yom Kippur War, they did more than choke supply. They shattered the assumption that oil was guaranteed. Prices quadrupled. Lines stretched around gas stations in the United States. Inflation soared across Europe. Japan, which had built a booming post-war economy on imported energy, faced an existential reckoning. Here's the mechanism. The fear of shortage multiplies the economic impact far more than the shortage itself. And here's what nobody tells you. The embargo succeeded not because the producers withheld enormous volumes, but because they exposed how vulnerable the entire world had become. But the story did not end with the embargo. In 1979, the Iranian Revolution disrupted exports again, igniting a second oil shock. Prices surged, recession followed, and governments scrambled to rethink energy policy. These moments form the historical skeleton of OPEC's power. Whenever the world assumes oil will flow forever, a disruption forces a recalibration of reality. When abundance appears, prices collapse. When scarcity looms, they explode. Yet the real lesson lies in how OPEC learned to modulate both conditions with increasing sophistication. By the 1980s, the organization faced its first internal fractures. Quota systems, production limits assigned to each member, were introduced to manage supply and defend prices. In theory, these quotas were the backbone of coordinated strategy. In practice, they were targets to exceed. Nations tempted by short-term revenue gains quietly pumped beyond their limits. Everyone thought they were safe. They weren't. The result was periodic price crashes, including the 1986 collapse when Saudi Arabia opened its taps in retaliation against quota violators, sending prices plunging by more than half. At first, it looked like a miracle for consumers. Then the bill arrived. Energy-dependent economies rejoiced, but petrostates destabilized. Mexico and Nigeria spiraled into debt crises. The Soviet Union lost critical export revenue during its final years. Here's why this matters. A price that is too low becomes as geopolitically explosive as a price that is too high. Little by little, OPEC internalized a principle that would define the next 4 decades. Control the perception of supply, and you control the price. They understood that oil markets are not governed solely by barrels pumped, but by expectations, rumors, and signals. A statement from Riyadh could move markets faster than an actual production change. Traders watched every press release, every ministerial meeting, every hint of discord or unity. This is where the pattern begins to form its modern shape, a hybrid of economics and psychology, amplified by the speed of global finance. The 1990s brought new pressures that challenged OPEC's cohesion. The Gulf War disrupted Iraq's production. Venezuela experimented with opening its industry to foreign investment, and non-OPEC producers like Norway and the emerging force of Russia gained global relevance. The cartel's share of world production slipped, yet its influence persisted. Why? Analysts suggest that OPEC's power now rested less on volume and more on swing capacity, the ability of Saudi Arabia, in particular, to increase or decrease production at will, stabilizing or destabilizing global prices. Not gold, not armies. Influence born from spare capacity held in reserve. But early cracks continued widening. In 1998, the Asian financial crisis suppressed demand, triggering another price collapse. By 1999, oil had plunged below $12 a barrel. Even Saudi Arabia, with its deep reserves, felt the strain. The internal question grew louder. Could the cartel maintain unity in a world where external forces, financial crises, technological shifts, political rivalries, constantly undermined its decisions? OPEC responded by forging the first of several alliances with non-member producers, bringing Russia into informal coordination. It was a preview of what would later be called OPEC+. But in the 1990s, the idea was embryonic, a recognition that control of the energy world required a broader coalition. And yet, the old problem lingered. Different nations had different needs. Some required higher prices to balance their budgets. Others needed lower prices to maintain long-term market share. Scarcity benefited some, abundance benefited others. The internal geometry of the cartel became an economic chessboard with no easy equilibrium. As the 21st century approached, something else emerged in the background, a shift that would define the next era. New technologies hinted that unconventional oil sources, from offshore drilling to early shale experiments, could one day alter global supply. If those sources matured, OPEC's dominance might weaken, and analysts argue that the cartel recognized this possibility earlier than most. They understood that the real challenge was not merely maintaining unity, but navigating a future where the world's appetite for oil might be threatened by innovation, policy, and eventually decarbonization. Yet, before those challenges fully materialized, OPEC would face one more seismic test: the realization that modern energy markets react not only to the physical movement of oil, but to the anticipation of decisions made behind closed doors. In a world of instant communication and hyper-financialized commodities trading, a whisper inside a Vienna conference hall could reshuffle the global economy. Everyone knew production mattered, but the danger wasn't what they saw. It was what they ignored, the psychological architecture that made OPEC's influence larger than the barrels it controlled. And that brings us to the threshold of the modern era, when a single meeting could redefine prices overnight. The mechanism that built this power was historical. The leverage that maintains it is geopolitical. But the world OPEC now faces is more complex than any it has encountered before. New producers, new rivals, new political alignments, and a new global economy where even a rumor of a production cut can escalate markets before a single pump changes its rhythm. The next part of this story reveals how that power operates today, how signals, alliances, and strategic cuts ripple through financial markets, reshape national strategies, and reshape the costs carried by billions of consumers from Lagos to Los Angeles. Today's oil market looks nothing like the one OPEC inherited in the 1960s. Demand has shifted eastward, technology has rewritten supply chains, and energy politics has blurred the line between economics and national security. Yet despite all of this, analysts suggest that OPEC remains one of the few actors capable of altering global prices with a single decision. The reason is not volume alone. It's coordination, it's perception. It's the psychology of scarcity in an era defined by financial volatility. And here's what nobody tells you. In the modern market, an OPEC production cut can move prices before a single well is touched, because traders are not betting on barrels, they are betting on signals. Here's why this matters. In an economy where everyday people feel the pressure of rising costs, the real leverage comes from the moment OPEC decides whether the world will wake up to cheap fuel or another round of inflation. To see how the mechanism works today, imagine a closed-door ministerial meeting in Vienna. 12 or more nations, each with different economic pressures, gather to decide whether production will rise, hold steady, or fall. A change of just 1 to 2 million barrels per day may seem small relative to global consumption, yet it can send Brent crude swinging by $5, $10, even $15 per barrel. Not because of the scale itself, but because of what the decision implies: tightening supply, expanding scarcity, or signaling long-term confidence. This is where the pattern begins to show its modern form. In a hyper-connected world, the announcement is as powerful as the action. Traders watch not only the numbers but the tone of the minister's statements, the vocabulary and press releases, even the posture of Saudi Arabia's energy minister during interviews. At first, it looks like theater. Then the bill arrives. But beneath the performance lies the central force driving modern energy politics. OPEC's partnership with non-member states through what is now known as OPEC+. Russia, Kazakhstan, Mexico, and others align in strategic coordination, creating what analysts describe as a shadow super cartel. This alliance emerged during the 2014 to 2016 price collapse, when the rise of U.S. shale flooded the market with new supply. For the first time in decades, OPEC's influence weakened not because of internal fracture, but because an entirely new competitor entered with unprecedented speed. Everyone thought they were safe. They weren't. The U.S. shale industry, using hydraulic fracturing and horizontal drilling, added millions of barrels per day, overwhelming global capacity to absorb the oversupply. Prices fell from over $100 per barrel to below $30. Petrostates faced fiscal crises. Investors panicked. The danger wasn't what they saw. It was what they ignored: the fact that shale could ramp up or down faster than conventional producers, rewriting the logic of supply control. When OPEC Plus formed in 2016, it was not merely a tactical coalition. It was a defensive structure designed to preserve price stability in a world where traditional dominance had been disrupted. Analysts argue the alliance works because each participant brings different leverage. Saudi Arabia brings swing capacity. Russia brings geopolitical influence, and smaller states bring incremental supply adjustments that help fine-tune the market. And here's the mechanism. By distributing responsibility across more actors, OPEC Plus can create the appearance of unity even when internal disagreements simmer beneath the surface. Not collapse. Coordination. A fragile but effective system. Yet, even with this expanded coalition, the challenges have grown sharper. The COVID-19 pandemic delivered one of the most dramatic shocks in energy history. As global demand collapsed in early 2020, oil briefly traded below zero, a moment symbolic not of fundamental value but of storage scarcity and financial panic. It revealed how deeply interlinked the modern oil system has become. If this pattern applies to future crises, then sudden disruptions, whether geopolitical or economic, could send prices spiraling in either direction faster than during any previous era. And analysts suggest this volatility is now structurally embedded in the market. Here's the trap. Petrostates depend on high prices to fund budgets, social programs, and political stability. But consumers, especially in large importing nations, are extremely sensitive to rising fuel costs. Governments fear inflation. Populations fear price shocks. Meanwhile, oil companies fear long-term uncertainty as the world pivots toward renewable energy. Each stakeholder wants stability, yet each incentive pushes the system toward instability. The tensions converge inside OPEC meetings, where ministers attempt to harmonize incompatible priorities in real time. The influence is not absolute, nor is it guaranteed. Analysts argue that OPEC's modern power depends on three pillars: cohesion, communication, and competition. Cohesion refers to the internal unity required to make coordinated decisions stick. Communication shapes market expectations. Competition, primarily from shale, deepwater projects, and other non-OPEC sources, sets the boundaries of what OPEC can and cannot control. If cohesion weakens, the price impact diminishes. If communication falters, markets interpret ambiguity as instability. If competition grows, OPEC must act more aggressively to maintain influence. Here's what nobody tells you. OPEC's strongest tool in the 21st century is not the embargo, not the quota, but the credible illusion of unity. Still, uncertainty looms. A new era of energy transition has begun. Nations are investing in electric vehicles, renewable power, hydrogen infrastructure, and efficiency technologies. Some scenarios indicate that global oil demand may peak in the 2030s or even earlier. Others suggest demand could continue rising for decades, driven by industrializing regions in Asia and Africa. The outcome is far from certain, but the psychological impact of potential demand decline weighs heavily on producers. If the world begins to pivot away from fossil fuels faster than expected, petrostates may accelerate production in the short term to monetize reserves while they still hold value. If this pattern applies broadly, the world could experience episodes of oversupply followed by aggressive cuts as producers attempt to defend prices. At first, the shift appears orderly. Then, the bill arrives. One scenario suggests OPEC will maintain influence by adapting to transition dynamics, managing not just barrels but expectations, using output decisions to stabilize markets during the long glide from fossil dominance to renewable competition. Another scenario points to fragmentation, rising internal conflicts, competition between OPEC and non-OPEC exporters, and shrinking fiscal buffers. A third scenario, more severe, imagines a world where geopolitical shocks destabilize energy supply chains, pushing nations into strategic hoarding, long-term contracts, and resource nationalism. In such a world, OPEC's power could either strengthen or weaken depending on how effectively it aligns with major consumers. But even as transition accelerates, oil remains deeply embedded in global infrastructure. Heavy industry, aviation, petrochemicals, and freight transport still rely predominantly on fossil fuels. Modern economies depend on oil not only as energy but as material input. And analysts suggest that this dependency grants producers leverage even as the world diversifies energy sources. Not dominance, persistence. Perhaps the most significant shift underway is geopolitical realignment. China has emerged as the world's largest oil importer, forging long-term partnerships with Gulf states. India's demand continues to rise. Africa's consumption is expanding. The center of gravity has moved eastward. Meanwhile, Western nations face political pressure to reduce dependence on volatile foreign supply while managing domestic energy affordability. The result is a global chessboard where OPEC's decisions intersect with great power competition. Every cut or quota adjustment reverberates not just through markets, but through diplomatic relationships. And this leads to a final revelation. The world watches OPEC not because it controls everything, but because it controls the timing. When supply increases, when it decreases, when unity holds, when discord leaks. Timing shapes expectation, and expectation shapes price. Let me show you exactly how this plays out. A well-timed cut during low demand can prevent a price crash. A poorly timed increase during inflation can trigger political backlash in consuming nations. A sudden realignment inside OPEC+, such as a dispute between Russia and Saudi Arabia, can send shockwaves through financial markets before a single barrel moves. The next decade will test the cartel more than any previous era. The rise of electric mobility, shifts in consumer sentiment, climate policy, and competition from agile producers will all challenge OPEC's ability to maintain cohesion. But analysts argue the organization still possesses the one asset no competitor has matched: coordinated spare capacity. The ability to swiftly add or remove supply remains the ultimate lever in energy geopolitics. And here's the trap. Every nation wants cheap fuel, but no producer can survive low prices for long. Stability requires balance, yet balance remains elusive. What happens next depends on decisions made within rooms the world rarely sees. Decisions shaped by economics, diplomacy, and often rivalry. Decisions that can either ease global inflation or ignite new waves of volatility. Decisions that remind us that despite the rhetoric of transition, oil remains the bloodstream of modern civilization. And as long as that remains true, one quiet vote inside an OPEC meeting can still change the world you wake up to tomorrow.